Welcome back to The Big Skinny with Lou Basenese. And without further ado, I'd love to bring in our first guest so I can serve up a nice apology for messing up his last name. Josh Young, it is a pleasure to have you joining us here today, my friend.
Thanks for having me.
Yeah, look, Bison, I apologize for that mix-up, but Bison do go right into the storm when one's approaching, and I feel like, based upon the information you share, and the fact that you're willing to be an oil bull in one of the times that bearishness on oil has hit a 17-year high, it's an apropos name. How did you get the name for Bison Insights?
Actually, my co-founder came up with it. He's not with Bison anymore, but we worked together for about 5 years, and he used to live in Wyoming, and he was just really into the West. And we kept meeting with people. We didn't have the name yet. We met with them, told them we were going to invest in publicly traded oil and gas companies, and we'd get laughed out of the room and down the hall. And so we figured, okay, we're going to face into it.
No, man, well, that's great. It fits right into it. So, I mean, look, right now, people are laughing at me a little bit. I think you tweeted it out, a fellow commodities resources guy, Rick Rule, who's been a mentor to me in the business. I responded, he used to say you're either a contrarian or a victim in the markets. And he said recently a quote that you said, he loves to buy things when they're hated, and oil's hated right now. So why do you love it so much, to start things off?
Well, I love it long term. I sometimes I'll comment on, hey, what do I think is going to happen in the next 3 months, 6 months, whatever. Honestly, I don't know. And I sort of like to joke that my short-term crystal ball is broken. So that I honestly don't know what's going to happen in the near term. And I'm not sure anyone does. But in the longer term, what we've seen is over the last decade, almost 15 years now, underinvestment in oil exploration. And so just like you're seeing with gold and silver and some of these other commodities where they've gone up a lot after people spent very little building new mines or drilling for new mining prospects, so too for oil, as you deplete the oil that you've discovered, it gets more expensive and harder to produce. And it means that the price is probably going to go up a lot. And it's just hard to tell exactly when.
Yeah, it's hard to time it, but we were talking in the intro about it. If you look at just the ratios to gold and other commodities, I mean, you had that great chart showing gold to the commodity index, which obviously the commodities includes things outside of oil. But how overstretched are we from your experience? I mean, you've been in this industry for a long time. How many times have you seen? I mean, outside of COVID, right? That was the most extreme case that we saw. But what's happened after other divergences like this in your history?
Well, COVID's a great example, right? We're almost as disconnected right now between gold and oil as we were then. And if you bought oil, if you ignore the negative, you've bought oil stocks during COVID, anytime around when the ratio was around where it's at now. With the bigger stocks, you were up a few X. With the smaller ones, I mean, we were up some ridiculous percentage, 10X plus on some of the stocks that we bought in 2020 by 2022. So I think you don't have to look that far back to see what this means. And, there's no guarantees. It's possible this time's different, but if you look back far enough, you'll see almost every time that gold has gone up like this, you've either already had oil go up a lot or you're about to have oil go up a lot.
Yeah, and if we think back, I mean, to COVID, right, there was legitimate demand destruction that happened then, right? The world shut down, global economy started cratering. I mean, GDP growth went negative pretty much everywhere. Fast forward to today, though, that's not the case, right? I mean, what's your take on demand and the various headlines we're starting to see now about demand increases versus demand destruction?
Yeah, so the reason for a crash or the reason for poor price performance is always different. Every cycle has its own narrative, it has its own downsides, and it has its own reason for the down cycle to end and the up cycle to begin. And then you get these things sort of exaggerated at extremes at the very end of the cycle. So the story around demand destruction was really big around COVID. And then we saw demand come back and the world reopened and oil prices went from -40 at their low to, I think it was around 130 or so at their high in 2022. So right now, the story is less about demand, which is obviously growing and it's beating expectations right now, both in the US and globally. It's more about supply, where there's this concern that there's going to be several million barrels a day more production on by early next year versus what we saw early this year, and that would lead to a multi-million barrel a day glut. So that's sort of the thing that people are really worried about.
And
That's what's weighing on
where are
prices.
they wrong in their thinking, though? Because if I look, demand from China, we're not going to go into a global recession right now. I have a hard time seeing where the demand destruction is. And I think Bloomberg was out with an article, too, showing that, we're not anywhere near peak oil demand. Actually, BP and other agencies are revising out their peak demand to 2030 and beyond, which this year was supposed to be the year demand peaked, right?
Yeah, I mean, I love that chart because they'll say it's scenarios and then they pretend like they weren't forecasting this, but they used to just not show a scenario where there was demand growth. So it's like,
Right.
okay, sure, technically it's not a forecast, but if you'll only allow for demand falling, then you're clearly giving a forecast that demand would fall. Again, it's not about demand falling, it's just about how much will supply grow and then how much will demand grow and how quickly will each of those grow and then when will they end. And so my view is that supply will struggle to meet expectations. And the more we grow production, the harder it is to sustain production because we're in this environment where there's been underinvestment for so long. And that's
Yeah.
the part I think people have so much trouble with, right? Is that if you underinvest, if you don't do the things you need to do 10 years ago, then every day gets harder and harder and harder. And that's the part really people I just don't think appreciate. This is a
Yeah,
great
let's
chart.
spend a minute there because it took, you may or may not know this. I was always a lifelong tech guy, got into the oil and gas industry at the beginning of the year. And that was one of the biggest revelations to me that, you just read the headlines and you think that there's unlimited supplies for us to keep increasing productions in the Permian. But then the shale decline rates are so rapid, 50% in year one. Why don't you explain that? You're almost essentially, if you keep increasing production, you get yourself on a treadmill here, right? And it's inevitable that if you don't invest in more discoveries, that you're just going to see declining rates. But why don't you articulate that so people understand it better? I know I didn't when I first got involved.
Yeah, sure. So these decline charts are helpful. Again, there is reinvestment, so it's not like there's no new production coming on. But the reason this matters so much is that a rising percent of production is coming from the high decline shale fields, and a falling percent of production is coming from conventional low decline fields. And then also, even in these conventional low decline fields, once they go into decline, they can start falling a lot. And so there's various different kinds of reservoirs. The water contact ones are the best, the water drive ones, where you basically have water pushing up, and the pipe comes in the top, and basically the water forces the oil up, and then at some point it's just water. And so you go from, this is what happened at Cantarell, you go from millions of barrels a day to thousands or hundreds of thousands of barrels a day, and production really collapses. So you need more and more replacement, and that means you need higher prices in order to induce that activity, and that's just not happening right now. So again, could it go lower? Sure, right? It's possible, anything could happen, but eventually you're going to need much higher prices to make up for these problems, and the lower it goes, the faster and the higher it should go.
Right. So you're of the conviction that lower prices today lead to an energy and higher crisis, and higher prices tomorrow, essentially, with tomorrow being in brackets. It could be 3 months, 6 months, 9 months from now. Where do you think it has to go? I mean, forget inflation adjusted prices, but now I'm seeing headlines from Enverus saying that shale prices need to go to 70 to, or for shale to be profitable in the Permian, 70 to 95. Diamondback CEO has been very outspoken about dropping rig counts as oil prices have fallen. So where do you think that equilibrium is, the sweet spot for oil prices for production in the U.S.?
Yeah, I mean, there's this popular TV show where they have this guy rant about how oil should be around 70 or so, which is complete nonsense. Oil needs to be way over $100 a barrel. And the way you can tell is you just look at the financials of these companies, and every one of those, when you look at them and you strip out one-time gains and you strip out all this other stuff, and you look at the actual profits that they generate versus the real costs, not the written down costs and not the sort of artificial balance sheets that they're holding, but the full cycle costs. In order to engage in the next bull market in terms of drilling activity and production growth, you need much higher prices, not a little bit higher prices. And so, again, I think people have recency bias, and we were huge beneficiaries of the technology gains and the efficiency gains of the US shale industry. Those are mostly in the rearview mirror, and we're seeing increasing problems. And yeah, sure, like it takes time. I like these images you guys are showing. It's it's tough, right? Like, and I
it's
think
hard to be
this
a
is
contrarian.
actually yeah. Well, this is partly why it matters so much to know which stocks to buy, because some of these things you can just get destroyed, and some of them I've owned, but fortunately, a lot of them that I've owned have actually done quite well despite this challenging environment. And that's really my day job, is to try to figure out, hey, how do I make money overall in this, both while oil prices are not doing so great and when they eventually go much, much higher. So
I want to get into your
I want to
strategy.
make money.
I want to get into your strategy in a little bit, but I want to articulate this some more too. I don't know that everyone realizes that, right now AI is the topic and trend of the day, the week, the year. But collectively, the AI trend only generates about, I think the stat I saw was about 80 or 90 billion in revenue right now from actual. But if you look at the oil and gas space in terms of cash flow per employee, in terms of total revenue generated, it's $1.5 trillion or more dollar industry each year in the US alone. Why are people like, I got to believe that you can find opportunities in good markets and bad because of the fact that we're really manufacturing, right? You're getting a product out of the ground and getting it to market. The ones that can do that efficiently will always make money in an up market or a down market, right?
Yeah, I mean, I think partly it's that, and partly in financial markets generally, there's almost always things that people hate and almost always things that people love. And generally, the things that people love, they love too much and they're too expensive. And generally, the things that people hate, not always, but some of those things can actually be really mispriced to the downside and should potentially actually trade a lot higher. And so a lot of it's just doing the hard work of sifting through the wreckage essentially through oilfield services and upstream and so on. And so, yeah, it's less about, I think, those revenue metrics sort of matter, but the reality is that AI is growing a lot faster than oil is growing. So it makes sense that those valuations would be higher, but it's not about, hey, this oil company should trade like an AI company. It's that this oil company should trade at a reasonable valuation based on
not like it's going out of business.
Cash flow.
Right.
Exactly.
So let's talk your strategy. I mean, because you run your own fund and money, but you also have a subscription-based service where you share ideas with everyday investors, anyone that signs up, the subscribers. I'm a subscriber. I recently had the note out where one of the Canadian plays was up 45% on an acquisition before you got a chance to recommend it. But how are you looking at the universe of potential opportunities to find compelling investments right now? That, where are they located in the market geographically, market cap size, in a nutshell, what's your approach?
Yeah, that was me whining a little bit about, we were like halfway through that write-up.
Dude,
it was like,
I've been there. I've been in the publishing business. Nothing worse than when you put the time and effort into it and you before you get to hit send, it's gone. The opportunity got realized already. So.
Yeah. So I've been investing professionally in publicly traded oil and gas companies since the last time it was popular, or maybe the time before that. So for too long, and launched Bison in 2015 with a co-founder who's now not with Bison anymore. And we invest in small, publicly traded, mostly upstream oil and gas companies. We'll also invest in services and in midstream. And then very rarely and selectively, we've had small private investments in mostly upstream oil and gas companies. So that's my one hat. And then the other hat I wear, I launched this blog newsletter thing via a separate media company where I share ideas of companies that I typically own stock in. Sometimes my fund will own it, sometimes my fund won't. And the thought there was just, I have all these social media followers and I see all of this, unfortunately, a lot of really bad advice and really bad suggestions. And I've tried to use social media to help educate people and share sort of what I'm doing and what I see. And it seemed like another way to go ahead and share these ideas systematically and in a compliant manner.
Yeah, no, listen, I came out of being a FINRA regulated investment banker, so I understand the compliance difficulties of doing that. I do want to give you credit and encourage everyone to follow you on X. You do a tremendous job of, one, sharing the data from others and then actually providing some perspective. I find there's a lot of people on social media that are just takers. They don't give any information. They just take it from others. You are very generous in that. So I encourage people to follow you. Right now, what do you think is the biggest misconception that's keeping people from investing? I mean, we showed the chart before. S&P 500, the weighting for energy right now is at like 2.8%, 3%. Now, like it's been trending down and it doesn't look like it's bottoming anytime soon.
Yeah, I think the IEA, that other chart you showed where they finally added a forecast that demand's growing, they've really not done anyone any favors because they basically gave this industry an idea. They give it a tarnish that it's going away. And I think once people realize that it's not going away, it has a shot to go from that 3% or so that you were showing of the S&P back closer to the average level of 10% or so. And again, it's not AI, so it's not the fastest growing. So maybe it shouldn't be 30% here, but at 10%, that's still enormous upside even for those largest companies. And it's wild upside for some of the small caps. So I'm interested in hated upstream companies. I've really gotten interested in drilling rig companies and certain other services, just because there's that physical equipment that you can
Right.
buy in some cases for pennies on the dollar. So, stuff like that.
Yeah. I had another question for you. It just escaped my mind. Oh, here it is. The bear side. Is there a technological angle that they'll say that, listen, we didn't have hydraulic fracturing. We couldn't go horizontal drilling, 10, 15 years ago. Now we're going out 3-4 miles laterally. Is there some technology that could disrupt all the economics here and really keep oil prices lower for longer while we increase supply? I mean, do you worry about that for any of the names that you're involved with?
Yeah, I mean, that was part of my motivation to spend significant time on oil field services companies, because the drilling rig companies and the completion companies and the chemicals and, sort of down the list, those are the guys that are going to see that technology first and in some cases offer it. And some of the most fervent oil bulls here, there aren't many, but some of the most fervent oil bulls are the CEOs of some of these technology companies and services companies that, if there was a solution like that, they would be implementing it and they'd be offering it to their clients and they'd be really heavily using it. And so, they're seeing the opposite of that, where they're seeing some of these technologies hitting their limits, things that were growing 10 or 20% a year from efficiency,
Right.
starting to grow single digits or less. And then the one other thing that I think I hear a lot in terms of a bear thesis is, oh, hey, we'll go do international shale. And people will point to various fields, in some cases Canada, which I know real well. I was a chairman of a Canadian E&P for a little bit, sold it for $100-something million. So Canada has good prospects, but is pipeline limited and unfortunately has gone pretty far down that sort of socialist regulatory and tax path. So it's really hard for Canada to grow too much. And then people will point to Argentina and certain other places like that, which are similar, but they have a combination of regulatory and tax issues, unfortunately, and risk that they'll get even worse geopolitically, but
Yeah.
also the resource. So Canada, the resource is there. Some of those wells are truly fantastic. Argentina, it's not quite there. The costs are still too high. The well productivity is still too low. So I think that the bear thesis, outside of oil's going away, which now even the IEA admits that it's probably not, is on these productivity gains and on these geographies that for the most part are not really playing out.
Yeah, you bring up some important points. I mean, geographically different, the just logistics in certain geographies. I got a question here from Chad Towers for Josh on services topic. Are you long Halliburton or NOV by any chance?
So I happen to not own those two particular ones. My take is generally to look down cap, because similar to what we saw in 2020, you could go buy Halliburton in 2020 and you got a nice, I think it was like a 3x or a 4x, something like that, from the bottom in 2020 up to the top in 2022. Or you could go buy one of these other much smaller companies, in some cases actually with a better balance sheet and a higher likelihood of survival, and that stock might have gone up 10x or 20x or 30x, something like that. So if I'm going to take that risk anyway, I don't necessarily need to own the name brand. And
Yeah.
I do like smaller companies. I don't need that high trading liquidity. I just look for the best deals that are most likely to go up and least likely to lose me money. And so that's where, the Halliburtons, they're great. They're wonderful companies, but they just trade at high valuations and they just have limited upside, even in an upcycle.
Yeah, listen, it's music to my ears because I'm a contrarian by trade, but I also love small caps. I've started out in Morgan Stanley's private client group and realized small and micro caps are where you can generate alpha the easiest if you actually do the work. Sounds like hopefully small caps are breaking out, the Russell 2000 finally hitting a new all-time high. So that should benefit the trade here over the longer term as bullishness on oil becomes more ubiquitous, which I think is ultimately where we go. It's a matter of when, not if. Any parting thoughts? I mean, things that you're watching that could on the radar in the next couple weeks. Do you worry about trade tariff headlines impacting global demand at all, or how is that impacting how you're investing and trading?
So honestly, I hope that we have world peace and I hope that stocks just go up and prices just go up. But I sort of want things to come down a little because I have some cash. I have these companies that are getting bought. And I honestly, if things had gone down this week instead of Trump sort of chickening out over the weekend, there would have been some wonderful additional buying opportunities. And then just the one last thought on all of this is I think like one of the biggest things to lose on in this space is companies that have too much debt or companies that have to go dilute themselves a lot in order to be able to survive through a downturn. So the companies I've been focusing on have been buying back stock, paying dividends, and generally, for the most part, a few exceptions where they're very levered and then have wildly asymmetric potential upside. But for the most part, companies that are able to sort of do those capital returns at low prices seem to be best positioned to be able to make it to whenever oil prices rise a lot. And if they can buy back shares while their stock is down a lot, then they have fewer shares with potentially the same earnings and same cash flow when prices are higher. So that's sort of been where I've been most focused, is on the return of capital guys rather than the sort of dilute and aggressively grow, but both could work.
Yeah, no, super sharp insights. I appreciate it too, that wisdom. Look, you're not just surviving, you're thriving because you've done it through multiple cycles in the oil and gas space. So that's no easy task in itself. I encourage everyone to go check out Bison Insights from Josh Young. Josh, really appreciate you sharing your wisdom with everyone here today. Wish you the best.
Thanks a lot. Thanks for having me on.